You're now listening to the Tax Smart REI Podcast, the number one tax podcast for real estate investors. Thanks for tuning into this episode of the Tax Smart REI Podcast. Today, we're going to be doing an update on the one big, beautiful bill. Senate has it in their hands, and they made some tweaks to it. We're going to go through what those tweaks are, how they may impact real estate investors and individuals like you, as well as we're going to be taking questions from the Tax Smart community. So stay tuned. We'll be diving into all of that in just 1 minute. Tap into real asset ownership with mineral rights and working interest opportunities, a smart way to invest directly in oil and gas production. Gain monthly income potential, upside exposure to commodity markets, and equity in the ground. Even better, mineral rights qualify for 1031 exchanges, allowing you to reinvest the proceeds from real estate and other qualifying assets while deferring capital gains. This is real estate under the ground, title, deeded, and owned in perpetuity. Whether you're seeking cash flow, long-term wealth preservation, or favorable tax treatment from working interests, these opportunities offer hard asset advantages with energy market upside. Don't just watch the oil and gas industry grow, own a part of it. Contact Eckert Enterprises today at eckertenterprises.com/taxsmartrei to learn more about how you can put mineral rights to work in your portfolio. Again, that's Eckert Enterprises/taxsmartrei to learn more about how you can put mineral rights to work in your portfolio. That's it for now, but we'll dive right into today's episode. All right, and we are back. So first we'll cover the bill, then we'll take the questions. So Ryan, what is the major benefit in this bill or the major change the Senate made to the House's version of this bill and how it may impact real estate investors?
The biggest thing is 100% bonus depreciation being permanent. So with the House, we had kind of a 5-year extension of 100% bonus depreciation. And this is actually how it's currently written in their text, kind of a draft. With the Senate is a permanent provision. So that to me, there's all sorts of other things. We'll highlight maybe just a couple others. But to me, and for the listeners, that's probably going to be if I had to pick one, the number one biggest thing coming out of this that I've seen.
Okay. So it's 100% bonus depreciation being made permanent means there's no phase out or elimination of it as far as this bill is concerned. That means that it's in there as a permanent provision of the tax code until if and when somebody else tries to change it. But this is great news for real estate investors and small business owners buying a lot of depreciable equipment and other depreciable assets that are eligible for bonus depreciation. Major, major win. And I've been talking to a lot of people. A lot of people have been asking about how likely is 100% bonus depreciation to come back. I've been saying it relatively clearly that it's one of the least expensive provisions in the bill. Everybody kind of wants it. Now the Senate wants to make it permanent. So in my opinion, as long as some type of legislation passes, it's pretty clear to me that 100% bonus depreciation is coming back, at least for the next few years, at the very least. But now Senate, they want to make it permanent, okay? So that is even bigger and greater news. To me, it's like a 95% chance that something passes probably this year. And with that, 100% bonus depreciation is coming back. So it's the closest thing to a sure thing you're going to get at this point without the bill formally passing.
Yeah, I had I'd run through kind of ChatGPT just to see like what it thought, the chances would be. And I said, hey, went through the House. The Senate seems to be on board with kind of their draft. And we already know that the White House with President Trump is very much on board for 100% bonus. So as you see it across kind of the 3 different departments, part of our system, it seems like a yes, yes, yes. So it said 75%. I think it was being a little bit conservative, but I would agree, Tom. I'm kind of leaning towards like 95%. So I think most people are probably leaning towards that. It's not a for sure thing. It's not in law. It's not there yet. So we can't base every decision based on that happening. But I think we're all saying there's a very high likelihood. And if you are someone as an investor who's good with 90%, 75%, whatever it's going to be confidence, then yeah, you might be making some decisions based on buying, selling, whatever you're doing based on that. But it feels like a huge win for our listeners.
Yeah. The question now is, will something get passed? And if you just look at the momentum behind what we're seeing this year with the new administration taking shape and also like what's going through, that it's passed the House, now it's on the Senate. And I think that there's a very good chance that something gets passed this year. And with that, it's almost certain that 100% bonus depreciation will be inside of that. Having said that, we said enough about bonus depreciation. Everybody out there with your short-term rentals, your real estate professional status, anybody who's trying to use passive losses, lazy 1031 exchange, trying to bank passive losses to offset gains and income from the future on passive income. This is all celebration. So let's clap it up and let's move on. Okay, we're going to move on from this. We're going to move on to some of the other things that are in this bill. I think the next biggest thing that I've been getting a lot of questions on is the SALT cap, right? So The House's version of the bill, they had originally placed the SALT cap, raising the SALT cap from 10,000 to 30,000, but then they fought and got it raised back up to 40,000. Now the Senate wants to knock it right back down to 10. So what does this mean? What is the SALT cap? Quick recap for anybody who might be tuning in or new to the show. When you get a federal deduction for the amount of state taxes you pay, local taxes, property taxes, and sales taxes that you can pay. It used to be, prior to the Tax Cuts and Jobs Act of 2017, there was no cap. You just deducted whatever you had against your federal income, and that was a nice little deduction that people had gotten. Tax Cuts and Jobs Act of 2017 capped it at 10%, which hurt a lot of people in high-income states. Think California, New York, basically most of the Northeast, and then also states that have high property taxes, places perhaps like Texas, Florida, and other states, New York, right? That kind of hurt those people in those states. But now, so they went to raise it to 40, which is what a lot of people wanted, but now they're bringing it right back to 10,000.
Yeah, it's kind of a bummer. I'm in Minnesota, so it's a high taxed state as well. So I know a lot of Minnesotans I've been kind of hearing from people are wishing that was higher as well. But yeah, I do hope it gets higher for us, but I wouldn't want to lose out on a provision like 100% bonus depreciation. I don't think that's like in the cards like we're talking about. But yeah, I do hope that they raise that. That'll be really impactful for a lot of our clients.
All right, so there's a bunch of other things in here. We're going to go over some things rather quickly and just highlights for those who may want to dive deeper. Okay, so for any syndicators or funds listening to the show, the general partners, you probably already know about the interest expensing limits under Section 163J. Basically, what this did was it says that the interest deductible that you were able to deduct, and there's often large amounts of interest when you're financing these very large properties, was limited to 30% of EBITDA, or you had to elect out and basically use the ADS depreciation system, which means you couldn't use bonus depreciation, which is what a lot of your investors want. So you're kind of stuck between a rock and a hard place. They do want to make this a little bit better. And what this means, you're not going to actually have to add back depreciation and amortization, which means you'll be able to deduct more interest and have higher net profit. So that's for our syndicators and funds out there. If you do want to look into that, go deeper. We have a mixed audience here on the show, so I'm not going to spend too much time on that. We're going to move right along. Another quick highlight for some of our business owners out there, the QSBS, the Qualified Small Business Deduction. Basically, they're raising the amount of, long story short, if you meet certain requirements and you sell your business, you're going to be able to exempt up to $10 million of gain. That was what it is today. They want to raise that to $15 million and make it inflation adjusted. So that's another little perk there for some of the small business owners who qualify for that exemption. If that does pertain to your situation, go speak to your advisor on how that might be able to impact you.
Yeah.
So two other things real quick to note here. Expensing Section 179, they are increasing the threshold to 2.5 million and the phase out they're increasing to 4 million. These numbers are up from the current provisions. So that's a nice little perk in there, mainly for business owners buying a lot of equipment, but can apply to certain commercial property owners. If you're in a commercial property space, that could apply to certain components in there. So it's something to keep in mind and also check in with your advisor. Now, this is interesting for factory expensing. And I know, again, this is more like the syndicators and the funds out there might be buying very large properties to build factories. If you're building certain factories that meet certain requirements, they're going to be entirely deductible. You'll be able to deduct the entire cost of certain factories. This kind of reminds me of the provisions they have for gas stations and certain car washes. You can basically expense the entire structure, not just certain components that are like have a class life less than 20 years or less. So that's interesting. That kind of remains in there.
Yeah. I think one of the things that we weren't really expecting was the QSBS, Qualified Small Business Stock expansion. We're not going to really touch on that more, but that was something that was new, that they increased the gain amount from 10 to 15. One other big one for our listeners, we've had a couple Opportunity Zone episodes here on the podcast. And one thing that came out from the Senate was making the Qualified Opportunity Zone permanent. So it would be something that would be a program, continue to be involved. We kind of thought like this might sunset after the 2026, but that seems to be kind of a permanent thing. Very similar, right, to kind of 1031s, but kind of their own different nuances there. There will be a small step up compared to kind of the first round that we had with the Tax Cuts and Jobs Act. So you'll get a small step up, kind of phasing up the longer that you hold the investment, pretty similar to what we had in the first round. And then, continued just making this a good program for us with some small other changes, but good to see that this is going to be there. Some of our clients do use this. And for business owners who are selling or people who want to get more into real estate and know they're going to do a long-term hold, 10 plus, right, kind of being the best advantages for taxes that you can get. That's good to see that this will continue on. I think that'll be impactful for kind of the communities that it was meant to help.
Yeah. And I think what's interesting here is that the phase out, so how qualified opportunity zones worked in a nutshell was you could take a capital gain from any capital asset, and you could still do that under these provisions. That's not changed. And you can invest into a qualified opportunity fund, which invests in qualified opportunity zone assets like a property you're going to make significant renovations on in a low income area that's designated as a qualified opportunity zone. As one of the incentives for making this investment or taking your capital gain and investing it into one of these qualified opportunity funds was the step up in the basis. So basically what happens is, say you invested $100,000 capital gain, would keep math really easy, into the fund. In 2017, if you held it for 5 years, you got a 5% step up. If you held it for 5 years, you got a 10% step up. If you held it for 7 years, you got a 15% step up. So what does that mean? When you invest into the qualified opportunity zone fund, your basis is zero. That's how it starts. That's how the regulations are written. So you invest $100,000 capital gain, you have a basis of zero. Held it for that 5 years, your basis is increasing to $10,000. That means you're only pay tax on $90,000 of that capital gain. If you held it for 7 years, that would increase to 15, and now you're only paying taxes on $85,000 of that. That phased out by the time we hit 2021 to the point where you can no longer use either of those, which is kind of a bummer. But now the way it works under this new bill, the way it's being worded by the Senate, is that if you, and this is permanent, there is no phase out of this, which is fantastic. In years 1, 2, 3, each year that you hold the investment for years 1, 2, and 3, you're going to get 1% each year. So for total, if you hold it year 1, you're going to have a 1% step up. In year 2, another 1%. In year 3, another 1%. Then in years 4 and 5, you're going to get 2% for each of those years for a total of 7 through years 1 through 5. Okay. Then year 6, you'll get a 3% step up for a total of 10%. Basically, it's an incentive to hold it. The longer you hold it, the bigger your step up is going to be. So, for example, in the $100,000 investment, if you held it for 1 year, you're going to pay taxes on $99,000 of your investment if you were to sell it after that first year. If you held it for that full 6 years, you're going to pay tax on $90,000 of that investment. And remember, that's just the step up on the original capital gain. Where the real benefit of qualified opportunity zone funds is if you hold it for 10 or more years, the gain on the qualified opportunity zone investment itself is exempt. So, for example, if your $100,000 investment increased to $500,000 because it was a successful project, that $400,000 gain, including depreciation recapture, would be exempt from taxes, which is fantastic. With 2024 officially in the rearview mirror, now's the perfect time to start planning for how you're going to maximize your tax savings in 2025. With major tax changes looming under the new administration and IRS audits on the rise, navigating the tax code alone is now riskier than ever. Whether you're leveraging the short-term rental loophole, claiming the real estate professional status, utilizing passive losses, 1031 exchanges, or anything in between, our expert team of tax advisors at Hall CPA has your back. We'll help you uncover hidden opportunities and avoid costly mistakes that could put you at risk during an audit. With potentially tens of thousands of dollars of tax savings on the line, why wait? Visit www.therealestatecpa.com/podcast to request your free 30-minute discovery call today. Again, that's www.therealestatecpa.com/podcast for a free consultation. Let's help you ensure you keep more of what you earn in 2025. That's all for now, and we'll dive right back into today's episode. There's a few other provisions of this bill we're going to talk about, and then we're going to move into some questions. Now, I know everybody's wondering, we're giving these periodic updates on what we're seeing. We're not quite doing a play-by-play every little thing that Congress is talking about. If you do want that, go ahead and subscribe to our newsletter. The link is in the description in the show notes. So you can go ahead and sign up for that newsletter if you do want more frequent updates. We're coming here, we're bringing you the milestones, right? When it first comes out, what does it look like? When it passed House, what did it look like? What's Senate currently talking about now? And of course, when it passes Senate, or there's any other material updates along the way, we'll let you know. But for those more play-by-plays, the newsletter is the best place to get those updates. So a few more things, then we're going to go into questions, okay? We have the qualified business income deduction. The House wanted to make it 23%. The Senate wants to keep it permanent at 20%. So that's slightly disappointing. It looks of a lower percentage than what the House wanted to, but we're maintaining the 20% in this bill, which is fantastic. Unfortunately, we were hoping to see a better carve out for specified service trader businesses like accounting firms, law firms, consulting, businesses where your expertise is really driving that. That's usually what we're seeing there versus where your assets are maybe driving it like other businesses. So unfortunately, there's no big carve out for that. It does look like there is a minimum deduction you'll be able to get, $400 for taxpayers who have $1,000 of QBI income. So yeah, it does look like there's a small carve out, but not as much as we would have hoped. Hey, real quick, if you've been a long-time listener to the show, then you know we give everything away for free, from how to use the real estate professional status and the short-term rental loophole to save tens of thousands of dollars on taxes, to upcoming tax changes, including the potential return of 100% bonus depreciation. We don't hold anything back. And the only way we're able to help more real estate investors is if you rate, review, and share the show. It just takes 15 seconds to leave a quick rating, review, or share with a friend who may find this information useful on their real estate journey. That's all for now. We'll dive right back into today's episode.
Last one that I was hoping we could talk about was the excess business loss rules. So the way that it currently is with current law is you can take the excess business loss, right? That's kind of married filing joint, 600 or so, kind of almost gets up to 700 these days in 2025. But what they've done in the text here, what we're seeing from the Senate, is basically remove kind of going from EBL, and then any carry forward right now goes in as an NOL, which is much more tax friendly because it's a slightly different calculation there. 80% of your taxable income, basically, you can take of the NOL that got carried over, say from 2025 into 2026. What they're doing right now, though, with the change is basically saying, hey, it doesn't get changed from an EBL, excess business loss, to then the next year being an NOL, which is the current rule. It basically just continues to be treated as an excess business loss. And therefore, you don't get the more friendly advantageous where you're still kind of capped at that roughly 600, 700 of loss that you can take, unlike what we currently have with NOLs, which you could take a higher amount of loss in the current year. So would be kind of a bummer. If that's the case, there is obviously, like when we talk with clients, some strategy that goes along with, hey, let's get the loss now because the next year becomes an NOL. That might kind of go away. Still significant to get, hundreds of thousands of dollars of losses that you get. It's just kind of a matter of timing, right? And when we get losses, we want to take that usually as soon as possible. Not always, but this would be kind of a bummer if that does change to that.
Yeah, I always found the excess business loss limitations kind of interesting because of the phase outs are so high. This really is only impacting basically people who have W-2 or very high portfolio incomes into the hundreds of thousands of dollars. Really, like you said, it's into the 600s, the excess business loss limits currently. So it's really not impacting that many people. And if you're generating that income from a business, it doesn't impact you at all. You could take unlimited losses. Real quick, just to recap for anybody who may be new, forgot what these are. Basically, what happens is if you have large losses from business, it could be from a business you're running, an operating business, it could be from real estate, like depreciation is causing a lot of these losses oftentimes. That limits the amount of losses you can take against your non-business income. So if you earn, say, $1 million in W-2 income, the max you're going to be able to deduct in 2025, if you're married, is going to be $626,000, okay? That is significant. So what that means is that if you were, say, earn $1 million, you would be able to deduct up to $626,000 of losses. The rest would be carried forward if you had extra losses, but you're still getting significant deductions, right? Now, the interesting part about this was that the way it worked since 2017 is those excess business losses. Say you had $1 million in income and $1 million in losses, and you were capped at the 626. That remaining difference, that 300,000 or so, would get carried forward into the future year, into next year, as a net operating loss, which you can use a net operating loss against up to 80% of your taxable income. So it's like a weird little kind of loophole, which I have to imagine was unintended, because when we first read this, I remember way back in like the day, it was like, this can't be right. And that's a loophole. That's what a real definition of a loophole is, right? That was not supposed to happen. And what they're doing now is they're patching that. And they're basically saying, no, it's not going to be an NOL. This excess business loss is not an NOL. It's an excess business loss carryover, which is going to apply to next year. So basically, that little cheat, that the little loophole that was there is now no longer there. Now, again, this is mainly going to impact high W-2 income earners and people with high amounts of portfolio income more than it's going to impact the business owner. So if you're a business owner, this does not apply to you. That's where the majority of your income is coming from. You're going to be in good shape. But there's just something else to point out. I know this did impact a lot of high income earners, and people have always had asked about this, and this is where we're at with that. So Having said that, those are the big takeaways from the big, beautiful bill update in the Senate. There's obviously other things in there, but we're not going to go through all of that today. The biggest one, again, just to summarize, is 100% bonus depreciation is coming back. I think QOZs, the QOF being permanent, probably the next biggest one for a lot of people listening to the show, which is exciting. Any final takeaways, Ryan, before we jump into questions?
No, I'm excited to see what actually comes about once they're done and they kind of vote on this. But yeah, stay tuned, whether it's things from Nathan Sosa that he's putting out or just anything at our firm. There's a link where you can kind of see the updates, and we'll be making regular changes to that as things happen. But yeah, stay tuned if you're curious kind of what happens.
Absolutely. So now we're going to move into some questions from our Facebook group. We might take some from the Insiders group too, time allowing. So let's go ahead with this first one. Of course, it's a short-term rental one. We're going to cover it nonetheless. I'm planning on closing on a short-term rental in September 2025. I won't likely have any rentals, so it seems like they're not having any guest stays, is what they're trying to say. Since beach season is peak season, that's after Labor Day. So basically, they're going to miss their peak season for renting it for the year. My question is, can I still make the regular depreciation deduction for repairs, about $20K, even though I might not have any rentals on the book this year? Basically, they're asking, could they take deductions if they're not going to have any guest stays? The short answer to that question is you could place the property in the service, right? You can place the property in the service, get it rent ready, list it for rent, have 0 rentals. You can do that. You can take the deduction, but it's going to be passive unless you qualify for reps. That's long story short. The reason for this is there is a tax court case. I don't recall the exact court case on top of my head, but we have discussed it in many episodes. You can go check those episodes out. But the tax court basically said, without any periods of customer use, it's impossible to determine the period of customer use. That's basically what they said. They said, you need to have periods of customer use. So if you don't have anybody rent out your property, you cannot say that it had an average stay of 7 days or less, and thus take it from the rental activity category and move it into that business category, which is critical to the short-term rental loophole and the entire short-term rental strategy. So to answer your question, yes, you could take the deduction. It's going to be passive. And it's probably not what you want. So you either want to get someone to rent it out for whatever you can get someone to pay for. That's fair market value. Whatever you get someone to pay for it, just to have someone stay at the property on the off season who's not your family member, okay? Or it's not you, because you want to make sure that someone gets in there if that's what you want to do for this year in 2025. If not, you might have to hold off to placing the service to 2026, which given that would be summer of 2026, may not behoove you. So I'm not trying to give you advice without knowing your entire situation, but what I would do is try to get somebody to rent it in, either at the tail end of the season as soon as you can, or just get someone to rent it out.
Yeah.
Just to get the loss, and that's your goal.
Yeah. If you're like most of our listeners, you bought this for the short-term rental tax strategy, and you're trying to get some losses to offset W-2 or business profits that you have. So if you're trying to do that, you got to get some stays, just like Tom said. Otherwise, you're not going to meet the short-term rental loophole. Just have to have an average stay of 7 days or less. That's the first thing. So if that's your goal, make sure that you rent it out.
Yeah, for sure. 100%. Here's a good one. Are there CPAs out there that will review your self-prepared tax returns for a fee? How do I go about finding one? Here's the thing. This is a good question. It's a philosophical question, maybe. Is there somebody out there who probably review your returns? Yeah, you could probably find someone, probably not easily identifiable. But for someone to go and review your returns, they're going to have to charge you a pretty significant amount to collect all that information, do a proper review of your returns. At that point, you might as well just have them prepare your returns for you. And look, I know there's a lot of people out there that swear by doing their own tax returns, but here's some reasons. I'm not trying to sell you on us per se, although we can help you with this if you want. Once you get deeper into real estate, not only does commercial tax software like TurboTax and H&R Block and so on and so forth, they have serious limitations on your ability to use certain strategies because they're limiting reporting capabilities, such as the short-term rental loophole, for example, and there's plenty more out there. I know for a while, TurboTax did not allow you to report QOZ investments, which I found to be very interesting. I don't know if they changed that, but that was a limitation for quite some time and still might be. Once you get into these more sophisticated strategies, it really is time to hire a professional, because even if you do spend all your time reading the tax code, and I'll get to why that doesn't maybe make sense in the first place, you're still probably missing critical things that someone who's a professional and experienced and has done this dozens and dozens and dozens, if not hundreds of times with clients, will be able to easily point out and correct for you. I mean, we have so many instances where we see from prospects and clients who do start working with us, where there's do-it-yourselfers, thought they had everything covered, and they made critical mistakes that either cost them tax savings or putting them in serious jeopardy for an audit, to lose an audit if they do ever get audited. So not only are you limiting the expertise that you're not getting when you're doing it yourself, but it's also the time element of it. Look, there's a book called Who Not How. It's by Dan Sullivan and Dr. Ben Hardy. It's basically about what is the highest and best use of your time, right? If you're a doctor, the highest and best use of your time is probably seeing another patient. Okay, it's probably where you're the highest best use of your time, not filing your tax return, not reading the tax code, right? Because that dollar value, if you're reading the tax code, you might think you're saving money, but that time could be better spent doing what you're good at, right? This is basic economics under The Wealth of Nations by Adam Smith, right? This is basic economics. People specialize in something and that gives them a higher dollar value of their time. Somebody else specializes in something else and then you trade, okay? And we trade with money in today's society. But what I'm trying to say is, for most people out there listening to this, doing your own tax returns, unless you're a tax professional or you have a very basic tax situation, is something you'd be better off delegating to professionals and tapping into their expertise and then freeing up your time to go do what you're good at, which probably makes you more money than the money you would spend paying somebody else to do it. And on top of that, even if you're not going to go pick up another shift or do whatever, what you can do is go spend time with your family, go spend time with your hobbies, go spend time doing things that are more enjoyable to your life, right? Than doing your own taxes. So I hope I'm helping you here. I'm not trying to sell you on our tax services. With this, I'm trying to help you put things in perspective so that you can say, you know what, maybe my time is better spent buying that next rental property. Maybe it is better spent doing another shift at the hospital or taking on that additional client and then paying someone else to do my tax returns. Maybe it's not worth the headache of doing this stuff. Maybe I just want more free time, right? So there's all these reasons to delegate certain things. And in your life, in an ideal world, you are doing what you're good at. You're staying focused on what you're good at and what you enjoy doing, and you're delegating the rest out, right? And that goes for taxes too, but this is an overall philosophy of life. So go ahead, check out the book, Who Not How. Highly recommend it. I think it'll be a game changer for a lot of the DIYers out there. And so we love you, but we're bringing you the book. Here's the water. I can't force you to drink it. So any comments there before we move on, Ryan?
It is interesting that they said they like spending their free time reading the tax code. So maybe it feels like truly a hobby. I don't know. We don't know this person, obviously. But their situation, they've got a new short-term rental, mentioned bonus depreciation in the loophole, 1031 exchange, sold their primary, lots of capital gains, donations through a DAF, and some farm expenses. I can't imagine anything going wrong there, to be honest. I can't. I really just can't.
No, I can't. Look at everybody in the comments. There's a debate in the comments. Most of the people are saying they don't do that. Most of the CPAs in there are saying they don't do that.
The liability.
So it's a liability. All right, yeah. Just look. At the end of the day, I said my piece on this. We're going to move on. We'll take a few more questions. And we'll wrap this episode up. Okay, here's another cheap one. Sorry, guys. Here's another cheap one. Can you recommend a CPA that's knowledgeable in real estate tax in Minnesota? Boom. We all know who the answer to that question is. So moving along, this one was, if I bought a property for $200K and sell it for $100K, can I write off a loss? What caveats do I need to consider? All right, so you bought a property for $200,000 and now you're selling it for $100,000. You theoretically have a $100,000 loss, right? Can you take that loss? Long story short is you can take that loss, but you have to consider in depreciation how long you held that property for, right? Remember, when we buy a property, you have your cost basis, which is your purchase price, plus some closing costs and whatever improvements you make to it over the time you own the property. Then you're going to depreciate that property over time. And then as you depreciate that property, you're going to have accumulated depreciation, okay? And that when you have accumulated depreciation, that lowers your cost basis and gives you your adjusted cost basis. So for example, a $200,000 property, if you took $10,000 of depreciation, your adjusted basis is going to be $190,000. So if you sold it for $100,000, you have a $90,000 loss. And just to clarify, that loss would be an ordinary loss. So that would be a non-passive ordinary loss because you're substantially disposing of the entire asset. And that's when that loss would get unlocked. So that is the questions for this week's episode. Hope that the Big Beautiful Bill update was helpful for some people out there. Again, looks very, very promising for real estate investors. Really excited to see if this gets pushed through Congress this year. I think it will. I think it's a very, very, very good chance. But we'll have to wait and see. So stay tuned and we'll catch you on next week's episode of the Tax Smart REI Podcast.